So till now, overall, what are we going to do in this subject, financial management? Broadly, we are going to take some financial decisions, not financing, financial decisions that can be broadly classified into three: financing decisions, that yes, investing decisions, and dividend decisions. Financing decisions are decisions taken with respect to raising of capital. By capital, I mean all the sources of finance, correct? And investing decisions are with respect to how am I going to deploy the funds that I have in the right investment avenues, correct? And having done everything successfully, how much amount of the retain, how much amount of the entire profit, how much should I pay as a dividend, and how much should I retain it with myself to my reserves? That's called as a dividend decision. Overall, this is what the entire subject talks about. Each chapter will be achieving either of the three objectives only. Clear with this, guys? This is what we have seen till now, and I shared the exam paper pattern, how it will look, and I also shared some insight about what are the overall careers or career opportunities that are available to you in the field of finance. Fine. So this is what we have done till now. So now let's continue the journey. So first of all, there is a very important concept. There is a very important underlying concept in our subject, which is called as time value of money, which you would have studied in your foundation. Anyways, I am starting it from the scratch because I will take it to such a level. Automatically from there, I will link it to your finance. Automatically from there, I will link it to your finance. By finance, I mean financial management. I'll link it to FM. So you know something. Still, I'm doing it so that from there I can link it. From there, I can link it to your FM. Clear with this? Now, sir, this chapter, time value of money, is not at all there in any of the 10 chapters that you had just told us. Yes, correct or not? Don't think of this as a chapter. Don't think of this as a chapter. This is like the blood. This is like how blood is important to our human body. It's like throughout the presence, or maybe a better example is this is like oxygen. Oxygen cannot be seen, but its presence can be felt. Correct? Trust me, once we finish this chapter, more or less throughout in your financial management, every single day you will be touching upon the concepts that I'm going to take today. Every single day we will be touching upon the concepts that we will be seeing today. This is such a very important aspects. Now, some people, they directly skip and they enter into the subject, but I just don't want to take chances because ideally this is a foundation level area, but there are certain other aspects that you wouldn't have studied in foundation that we will be dealing here. So I don't want to take any chances. So that's why I'm starting things from the scratch. Clear? But please participate. I'm humbly requesting you, please participate. Now, we all use this freedom of speech only in our social media handle. Use it in the classroom. Use it in the classroom. This is the real knowledge that you will get. Use your freedom of speech in the classroom. You want to learn, that's all. That's all. For learning, whatever it takes, you will do it. Yes, bring the child mode. Don't think about anyone. Just think about learning the concepts. I'm sure you will automatically start learning everything, and you will automatically handle the subject, whatever kind of questions comes your way. Clear with this? So the first aspect that we are going to see here, let's say, I'll take this as part A. Part A, we will take this as time value of money. Time value of money. I would have given you some handouts, right? That handout, you keep it safely. Right now, it's not required. Yes, this handout. Okay, so basically, we will be touching upon the time value of money part first. That is basically entirely classroom discussion. I'll be walking you through. I'll just ask you to write down certain things, formal notes, and your running notes. Have that. That goes without saying. I need not keep telling you again and again. That goes without saying. That's how our classes will function. Okay. Having done this, we will be doing certain questions that are linked to some securities valuation. I will tell you what that is. I will tell you what it is. Once we finish part A, automatically, I will link it with part B. That's where from whatever time value of money that you have studied in your mathematics, right? That I will link it with FM. Clear with this? Clear with this? It's a structured way of learning. Once we do this, don't think it's a waste of time. Don't think it's a waste of time. This is the basic. This is the basic from where the entire subject will be built. So I am introducing you to the subject in a very structured approach. Please follow the same so that you will also get a proper understanding of the subject. That's very important. So I could have easily gone in the study materials order, but I have sequenced it in such a way that it will not hinder with the logical understanding. So that is the reason why we are learning this concept called time value of money right now. A very, very important aspect which might not be asked separately, but this is imbibed in every single question that is there in financial management. Clear with this, guys? Clear with this? Such is the importance. Such is the importance. Now let's get started with this. Now let's get started with this part A, time value of money. Now first, introduction. Now let's say I give you two options, guys. Now let's say I give you two options. Let's say option number one. First, what is this context? You have never explained it, sir. Straight away you're going by examples. By way of examples, I will introduce you to the concept. Fine. Now I am telling you, fine, you forget whatever knowledge that you currently have on the subject. I'm just starting from the scratch. Now I am giving you two options. Option number one, I am asking you, I'm telling you, you take 100 rupees today. I'm telling you, take 100 rupees today. Or I'm giving you one more option. Take 102 rupees after 1 year. I'm giving you two alternatives. I'm giving you an option. Today I will pay you 100. Okay. Let's say you have sold me something or some commercial transaction has happened. I am giving you two options. Option number one, today take 100 rupees, go. That's all. Or option number two, today I will not pay anything. After 1 year, I will pay you 102 rupees. Okay. Now, which of the two options is better? Okay, fine. Let's start the poll. First, how many of you say option one, today 100 rupees is better? Oh, so many students. Okay, fine. Great. Down. How many of you say 102 at the end of year one, sir? That is the best option. How many of you say? Own your opinion. Don't look back. If you think that is the right answer, you are the best judge for yourself. Up. Come on, guys. We don't have much time. Up. That is, sir? No. Okay. Say right. Okay, fine. Okay, fine. Right. Okay, first, who all didn't raise your hands? Now you raise it. You never raised it. Why? You need not know 100%. Just tell what you feel. No, what is the problem, guys? Once again, option one. Who all say option one is correct? Okay, fine. Option two. Now he is raised. Right, okay. Okay. Is there anyone who says neither of the options? Thank God. No one, huh? No one? Now, 1 second, guys. 1 second. I'll tell you, first of all, these two options are not at all comparable. So neither of the options are right. These two options are not at all comparable. Example, 2 monkeys plus 5 donkeys is equal to how much? 2 monkeys plus 5 donkeys is equal to what? 7 what? Aliens, huh? Another? Can you add or can you compare dissimilar items? No. Now the question is, sir, why are you saying that these two are dissimilar items? Correct? That arises or not, guys? Yes. Why are you saying these two are dissimilar items? This is also in rupees, this is also in rupees. No. I'll tell you one example. Especially in your houses, if you have grandparents, you tell them, I'm going for a movie. Yes, they will ask you how much you paid for the ticket. You say 200 rupees you paid. They will say, in our days, that's how they will start, no? In our days, we paid 1 rupee and we saw MGR movie or whatever. Yes, all those old times, during that point of time, whatever movie came, yes, they used to tell like that. Yes or no, guys? Now, if you take the same 1 rupee and if you go to the counter today, what will that guy tell you? Yes, nothing, literally, fine. Literally, that 1 rupee doesn't have a value today, correct? Now, is it fair on her part, your grandparents' part, to compare the 1 rupee that they paid 20, 30 years ago with the 1 rupee that you're going to pay today? Guys, yes or no? Yes or no? Absolutely not. Because over time, the value of money changes. Are you clear with this? And hence, the same amount of money and any cash flow that is occurring at different period intervals are not comparable as such. Are you clear with this? Are you clear with this? Why? That is because over time, money ideally loses its value. Sir, how are you saying loses, sir? Earlier, one ticket I paid 1 rupee. Today, the same ticket I'm paying 200 rupees. So money value has appreciated. No, money value has not appreciated. Now, you get the same benefit. What is the benefit? That movie watching experience you get. Earlier, if you pay 1 rupee itself, you are able to get that experience. Correct? For you to get the same experience now, if I pay 1 rupee, say 1 rupee is not of any value. Pay 200 rupees, only then you will get the same benefit today. Correct? So can I say either the value of the product has increased or the value of money has decreased? In our case, value of product has increased. No, it is the same movie watching experience. So why is there a difference in the amount you pay? Because the value of money has decreased over time. Correct or not? Yes, guys, are you all understanding? Yes, now they say, take another example. Property rates. 20 years ago, 20, 30 years ago, you can buy one flat for 1 lakh rupees. Right? The same flat will now cost at least 50 to 60 lakhs. Correct or not? Why? Time value of money. Over time, the value of money changes. Can I directly say 1 lakh, I will pay now also 1 lakh? No. No. Correct or not? So, to put it short, the cash flow arising at multiple point of time, at multiple periods are not comparable as such. Yes. Correct or not, guys? Cash flows arising, please write down, arising at different periods are not comparable as such. Yes, are you clear with this? Are you clear with this? Can I compare 100 rupees today with some other money that I'm going to receive after 1 year? No. Correct or not? These two are not comparable. Sir, you are saying not comparable. Then how can I make it comparable? Only if I make it comparable, you will be able to decide whether to take 100 rupees today or 102 after 1 year. Correct or not? So first thing I need to do is I need to make these two options comparable. Correct? How do I make these two cash flows comparable? Using concepts called as using time value of money techniques. Using time value of money technique, that brings us to the second concept. Write down time value of money techniques. This chapter is called time value of money. The short form is TVM. Okay, time value of money techniques. Time value of money techniques. So what is the time value of money techniques, sir? There are broadly two techniques. Now let us just understand the same example I gave you. 100 rupees today, can I say it is the present value? Can I say it is the present value? Value at the date of present, correct? This 102 is some future value, correct? It is the value that will be arising on a future date. Correct or not, guys? Please participate. Yes. Now I have two options. Sir, how can I make them comparable? You take this 100 and find out how much this 100 will be worth at the end of year 1, correct? Or in other words, I can find the future value of the current cash flow, correct? And I will get some figure. This 100 I have converted into at the end of year 1, whatever is the value, that can be directly comparable with 1 or 2. Yes or no? Or another option is this 102 is at the end of first year, correct? I can find out what is the current value of the future cash flow. Yes or no? I can arrive at today's value of tomorrow's money. I will get some figure. Yes, that I can readily compare with 100 rupees that I'm offering. With this, you can take a meaningful decision. Correct or not? Correct or not? So, in other words, can I say there are two techniques of time value of money. One is future value and another one is present value. Yes, சின்ன முத்துகோண்டு பெரிய முத்துகோண்டு அந்த மாதிரி தான். Future value, present value. Correct? Yes. One future value is called as compounding technique and present value is called as discounting technique. Please write down. Please write down. Please write down. Two techniques. Okay, 1 second. Yes, two techniques. Pull an arrow here. Pull an arrow here. Write down future value and present value. Future value and present value. Future value is called as compounding technique and present value is called as discounting technique. I will tell you why it is called such in a short span from now. Please wait. Okay, so future value means what? I have today's cash flow. I will use some technique and convert it into tomorrow's value, that is future value. Correct? Or I have a future cash flow, with that I will do something to arrive at today's value of tomorrow's money. Are you clear with this? Are you clear with this? Why are we doing? Only then cash flows are comparable. Are you clear with this, guys? Are you all clear with this? Are you all clear with this? Now let us say I'm giving you an example. I'm giving an example. Let's say you have 100 rupees today. You have 100 rupees today. Let's say the interest rate is 10% per annum. That is, let's say a typical example. If you open an FD, you know, fixed deposit. Yes. Today you pay the bank 100 rupees. The bank is saying we will pay you 10% interest. That is the rate of interest. Okay. Fine. Now you tell me what will be the value at the end of year 1? What will be the value at the end of year 1? 100 plus whatever is the interest that you get. Can I say the value at the end of year 1 will be 110? Correct or not? Can I say this is the present value 100 and this is the future value 110? Correct? Or can I put it in a small formula? And say, please write down the third one. I will give you sufficient examples. Please don't worry about it. We have just started. Okay. Write down compounding technique. First, we will talk about the future value. Compounding technique. So here the formula is, can I say future value is equal to present value into 1 plus r the whole power n. Please note it down. I will logically derive this. Now you have today's value. In our example, I know today I will be paying him 100 rupees. Correct, guys? Now he is saying 1 plus r means what? It is the interest rate. What is the interest rate? 10%. 10% can be written as 0.10. Can I say this is plus 0.10 to the power n? We are trying to find out the value at the end of year 1. Correct? So n will be 1. N is the period. Correct? Now just apply this formula and see how much it is coming. This is 100 into 1.10. How much is this? Rupees 110. Can I say this is the future value at the end of year 1? Correct? What is the future value at the end of year 2? Just apply the same formula. Present value is 100 into 1 plus 0.10 to the power 2 at the end of year 2. How much is it? It's going to be 121. Now, sir, you are giving me some formula. What is the logic for it? You guys would have already seen this formula in your foundation. Anyways, let me just give you the logic for this. This is not required for exam, but I'm just telling you, since it's a conceptual learning, you need to know why this formula. If you mug this up and go, then also you will be able to crack it. But just that I'm telling you the logic for this formula. Let's say, I'm just opening some column here. Now, let's say I am opening an FD, okay? I am putting it as year 0. Year 0 means today, right now, this second. Let's say I am introducing 100 rupees, okay? Today you are giving the bank 100 rupees in FD, correct? Today itself, will the bank pay you anything? No, correct? So basically the closing balance as on today is going to be 100, correct or not? Fine. At the end of year 1, let's say January 1st, you put 100 rupees, and on 31st December, end of the year. So what is the opening balance? Opening balance is the previous closing balance, 100 rupees, correct guys? Guys, everyone participate, correct? Now, what will be the interest? He will pay the interest in the opening balance, correct or not? Throughout the year, he has used your 100 rupees, correct? On that, he will pay 10%. How much is that? 10 rupees. So, closing balance is how much? 110, correct? Now, you are not withdrawing this. You are not asking him to pay out the interest to you. You are saying, please cumulate it. Please, you know cumulative FD? Yes. They will not pay you the interest. Keep on accumulating. At the end of 3 years, 5 years, whatever it is, whatever is the value that you pay me. Clear? Clear? Our entire concept of discounting and compounding arises only in case of reinvestment assumption. Reinvestment assumption means you will not withdraw the money then and there. Clear with this? This is the assumption we take. So for the year 2, can I say the opening balance is 110? Guys, correct? Yes, correct. Now, for the year 2, he will pay 10% on 110, correct? Because the entire 110 is available with him for the entire period of second year, correct or not? So how much will be the interest? 11. So what will be the closing balance? 111. Third year, it's going to be, sorry, this is 121, 121. So the third year opening balance is 121. On this, you will pay an interest of 10%. How much is that? 12.1. So what is the closing balance? 133.10, correct? Now, sir, why are you doing all this? I know. Wait, let me just come up with the formula and link it to you here. Now, this 110, can I say this is nothing but 100 plus, what is this? 0.1 into 100. Correct or not? That's how you got this figure. Or can I say this is nothing but take 100 common, 100 into 1 plus 0.1. Correct or not? To the power 1 is 1 and the same. Correct, guys? Are you understanding this? Yes. Now, at the end of year 2, you get this total closing balance of how much? 121. How did you get this? It is opening balance of 110 plus 0.1 on what? 110. Correct or not? Take this 110 common. How much you get? 110 into 1 plus 0.10. Correct or not? Can I say 110 you got here? No, this is nothing but 100 into 1 plus 0.10. Can I substitute this 110 and write it as 100 into 1 plus 0.10? Yes or no? And then multiply this once again with 1 plus 0.10. Correct or not? Or this is nothing but 100 into 1 plus 0.10 square. Correct, guys? Correct. This is nothing but your formula. Your future value at the end of year 2 is equal to present value into 1 plus r the whole power n. Are you clear with this? You guys are able to understand this. So if someone asks you, what will be the future value at the end of year 2? Directly you can just use this formula and arrive at the future value, correct? Provided you have the present value. Present value means what? Today, whatever is the value. If I invest 100 rupees, at the end of year 3, what is its value? Are you clear with this? Are you all clear with this? So this is the logic behind this formula. Can we take one small example? Please write down an example. And here if you see, 100 is the present value. 110 is the future value at the end of year 1. 121 is the future value at the end of year 2. 133.10 is the future value at the end of year 3. Correct, guys? And how can you, without using all this table, can you directly arrive? Yes. How? Using the formula. Future, please tell me, what is the formula? Future value is equal to present value into 1 plus r the whole power n. And I have just derived the formula for you. Are you all clear with this? Simple logic, if you understand, automatically. So every time using this table and logically arriving at it might be difficult. Directly, let us make use of the formula. Are you all clear with this? So please take down a small example. Please take down a small example. Example, Mr. A invests rupees 100 today. Rate is equal to 10% per annum. How much will he receive first after 1 year? Number 2, after 2 years. Number 3, after 3 years. Number 4, after 4 years. Number 5, after 5 years. Now, quickly compute and tell me. Use the formula. What is the formula? So, future value is equal to present value into 1 plus r the whole power n. Correct, guys? Correct, guys? Yes. So now here, please write it down. Write it down. So here at the end of 1 year, it's going to be substitute the formula here. 100 into 1 plus 0.10 to the power 1. Correct, guys? Yes. Here it's going to be 100 into 1 plus 0.10 square. I mean to the power 2. Here it's going to be 100 into 1 plus 0.10 to the power 3. 100 into 1 plus 0.10 to the power 4. And 100 into 1 plus 0.10 to the power 5. So tell me how much, and how much. Figures. Hello? Yes, 110, then 121, then 133.10, then 146.41, then 161.051. Now you might be wondering how some students got it so quickly. There is a simple calculator trick for this. There is a very simple calculator trick for this, and that is the reason why I asked you to bring this calculator, and I was very specific about the usage of calculator and all that. Now guys, if you haven't done till now, it's okay, just wait. Patiently listen. Now, the problem here is all these things are in power, correct? So basically, can I say this is nothing but 1 plus 0.10 is nothing but 1.1, correct? So 1.1, I need to keep on multiplying 1.1 with itself again and again and again. That is called power, no? Correct? The power 2 means twice, 3 means repeated. Clear? Again and again doing it physically, 1.10 into 100, then 1.10 into 1.10 into 100. It is actually a waste of time doing like this. There is an easier method. Just pick your calculator. Please pick your calculator and just do what I say. Guys, please, you can do your own calculations a little later. Please follow whatever I'm saying. Pick your calculator. Now type 1.1. Just type 1.1. Correct? 1.1 to the power 1 is always 1.1. No problem. 1.1 power 2 is 1.1 into 1.1, right? 1.1 power 3 is 1.1 into 1.1 into 1.1. Instead of doing this again and again, there is a simple trick. You have typed 1.1, click the multiply button once, correct? And click the is equal to button once. How much you get? How much you get? So this is equal to 1.21. That is 1.1 to the power 2 is nothing but 1.21. Wait, don't do anything in the calculator. Click is equal to one more time. Click is equal to one more time. How much is it? It gives you 1.331, which means you have once again multiplied the same number with 1.1. Clear? Click is equal to one more time. How much is it coming? 1.4641. Correct? Click it once again. How much does it come to? 1.61051, whatever it is. Fine. Are you clear with this? So when you want to multiply the same number again and again, what you do is type the number that you wish to multiply, yes, into once is equal to you will get the figure, again is equal to the next figure, again is equal to next figure. Are you clear with this? Simple guys. Are you all clear with this? Any doubts here? Anyone has any doubts? Does it not work in your calculator or something like that? Because some brands will have some issues. What happened? Which brand? Yes, it's okay. Tell me, no, which brand? Casio only. Hey, you cannot have that calculator. Exam, it's prohibited. Such a scientific calculator. You cannot have that. In fact, in scientific calculator, it's much more easier. Adiliye to the power la irukum. Power order click panale porum. It's not allowed in the exam. Please don't use that calculator. Don't bring it for tomorrow's class or next class. Please don't bring it. இதெல்லாம் allowed தான் நினைக்கிறேன். This is not scientific calculator. Okay, guys, anyone has any doubts? Please, let's not waste further time here. Let's not waste further time. Does anyone have any doubts? If you want to power a number, again, what some students do is they will type 1.1 into is equal to into is equal to into is equal to 14.8. Don't multiply the enter that multiply button again and again. Multiply button should be typed only once. Is equal to button alone, you need to keep clicking it based on the number of periods for which you want to do it. Are you clear with this? Are you clear? So 1.1 if you do, click into, and if you click is equal to, you will get the second year's factor, correct? Click again third year's factor, click again fourth year's factor. Are you clear with this? Are you clear with this? Is everyone clear with this? Did anyone teach you in foundation level? This was taught. This was already taught. Perfect. Right. Clear with this, guys? Clear with this? And once I find this, once I find all these factors, it is simple, right? I can directly multiply and get the answer. Are you all clear with this? Are you all clear with this, guys? Yes, you are all understanding this? Perfect. Now in exam, what they will do is, these factors, they themselves will give you. These factors, see, if you see, this is called as future value interest factor. That is the amount by which it compounds. It's called as future value interest factor. Whatever you are putting here within the to the power you're doing something, no, this component alone is called as future value interest factor. Okay, and institute, they have given you a future value interest factor table. All these things will be given directly in the exam. So then why should we take the efforts in doing this? Not every time will it be given. In case it is not given, then you should know how to handle it by yourself. Are you clear? You cannot say, question less, something is missing, so I will not answer. You cannot say this. These are some basic things that you need to know. Are you clear? Can you just take this table that I had given you? That financial tables I had given you, right? There are multiple tables in that. I'll tell you what is what. Okay, fine. Just go to this. Now, guys, if you look at this, yes. If you look at this, guys, I will tell you how to use this table. They have given here, what is this table? Future value interest factor. When will you use? When the present value is given and your interest rate is given and the number of years is also given, you need to arrive at the future value. How can you find out? That is what is being covered in this table. Now, in our example, what was the interest rate? 10%. So you go here. This is the relevant column for us. 10%, correct? First, you should pick the right table. There are 4 tables that I've given you here. See, here there is a future value table. Then here you have a present value table. Then you have 2 more tables. Some future value annuity table and present value annuity table. You should pick the right table. Don't go to the wrong table and say, sir, answer is not coming. Fine, clear. That's why I gave it to you right on day 1. All the time that we are spending here is an investment. Whenever we are doing sums, each sum will have its own concepts by itself. There we cannot spend the time on time value of money concepts. So there the entire focus will be on the concepts related to those particular sums. That's why I am just keeping the base ready. This is like a runway. Once everything is fine, we can beautifully take off. Clear with this, guys? Now in our example, present value is given. We need to find out future value. That's why I'm going and to the future value table. It's called as future value interest factor. Okay. Now here they have written something. If you can see it here. Here they have given within bracket I and N. What is I? What is N? I stands for the respective interest that is covered here. And N stands for the number of years, that is the period that is covered here. So the future value interest factor of 10% at the end of 1 year is going to be how much? 1.10. At the end of 2 years is going to be how much? 1.2. 210. This is what we did it here. This is nothing but 1.10, 1.21, 1.331. All these things are only given here. 1.464, 1.464, and here it's 1.611, 1.611. Instead of doing all this calculation, they themselves have given you by way of a table. If the table is given, pick it directly. Don't take the efforts in doing manual calculation. Are you clear with this? Are you all clear with this? Ideally, all these things should have been covered in your CA foundation. Anyways, I am just doing it for the benefit of everyone. Clear with this, guys? Clear with this? Perfect. Now, when present value is given, when your when your present value is given, present value into 1 plus r the whole power n gives you what? Future value. Correct? Now, when future value is given, can you find out the present value? Yes. So we know that if you see, future value is equal to present value into 1 plus r the whole power n. Correct? Suppose they want to ask, they want you to find out the present value, but they have given the future value, rate and number of years. You can easily, can I say, present value is equal to future value divided by 1 plus r the whole power n. Correct or not? Yes. So this, if I multiply, that's called as compounding, and if I divide to arrive at the present value, it is called as discounting. I told you, today's value can be converted into tomorrow's value, or today's money can be converted into tomorrow's value, or alternatively, tomorrow's money can also be converted into today's value. Correct? If I'm having the future value, I want to find out the present value, I will discount. Are you clear with this? And throughout our subject, we will be talking about discounting. Compounding generally, not in many areas it will come. Discounting is what we will be doing left, right and center, we will be seeing. Clear? So write down the fourth concept. The fourth concept, write down discounting technique. Discounting technique. It's also called as present value technique. Present value technique. What is the formula, guys? Come on, tell me. Yes, present value, that is what I need to find out. They have given me the future value divided by 1 plus r the whole power n. Are you clear? The logical derivation for compounding I told you. Then simple cross multiplication, you will arrive at discounting. Clear with this? Clear with this? Today's value multiply, you get tomorrow's value, or tomorrow's value you divide, you get today's value. Simple, guys, simple. Now can we just take one small example? Write down example. Now example number 1. If the future value at the end of year 1 is going to be rupees 110, rate is given as 10% and the period is given as 1 year. Calculate the present value. Can you find this? Guys, can you find this? Yes. So this is nothing but you guys know present value is equal to future value, that is 110 divided by 1 plus 0.10 to the power n. What is n here? I have given you future value 1, which means future value at the end of year 1. So which means to the power 1. So how much is this? Hello? Yes, so this is nothing but 110 divided by 1.10. How much is that? Rupees 100. That is, from 100 you can arrive at 110, or from 110 you can arrive at 100. Correct? From 100, if you find out 110, that's called as compounding. From 110, if you arrive at 100, it's called as discounting. Are you clear? One is multiplication, the other one is division. And multiplication is called compounding, division is called as discounting. Clear with this? Clear with this? Clear with this? Fine. Right. Now, take another example here. They have given you future, I hope you guys are writing along. Future value 2, that is at the end of year 2, is 121. The rate is given as 10%. The period is given as 2 years. Calculate the present value. Can you calculate this? Can you calculate this? You guys know present value is nothing but the future value 121 divided by 1 plus 0.10 to the power 2. Correct? Guys, correct or not? Yes. Now, you again have this think that in the denominator there is something that you need to do to the power of. Correct, guys? There is another trick for this. There is again a trick for this. Now, in the denominator, what you need to do is take your calculator. 1 divided by 1.1. Correct? How much is it coming? Now, once again, go to year 1. Go to year 1. Can I say this is nothing but 110 into 1 divided by 1.01 to the whole power 1? Correct or not? Correct or not? Can I say this is nothing but 121 into 1 divided by 1. Sorry, this is 1.10. 1.10 to the power 2. Correct or not? Guys, correct or not? 1 plus 0.1 is 1.1, no? Correct? So can I say this? Now, this alone, if I'm able to have some calculated trick to find the value, that I will just multiply with the respective figure. Correct or not? Now, how can I do this? Very simple. Take your calculator. Type down 1 divided by 1.1 is equal to, how much is it coming, guys? How much is it coming? This is the present value factor for the first one, 0.909. Correct? You need not do anything. Click is equal to once again. How much you get? How much you get? How much you get? 0.826. Correct? That is the factor for year 2. Click again, you will get the factor for year 3. Click again, you will get factor for year 4 and so on. Clear? So 1 divided by 1.1 is equal to, you get for the first year. Click is equal to second year, is equal to third year and so on. Are you clear with this? Simplest trick to use your calculation. Basic things that you should be knowing while you are entering into this subject. Clear with this, guys? Clear with this? So tell me, what is the value here? What is the value here? This is nothing but 121 into, we just found out, 0.826. How much is it? How much is it? 99.999. And yes, you can round it off to 100. Now another thing that students generally ask, sir, 3 decimals, 4 decimals, your wish. I would say, look at what, this is nothing but I have just taken this from the institute study material. Okay, I have just taken this from the institute study material. Okay, now what has the institute done? How many decimal points have they kept? How many decimal points have they kept? 3, no? Everywhere you can find only 3. Correct or not? Let us follow that. As simple as that. Clear with this? The institute is having a requirement. Let us acknowledge it. As simple as that. Clear with this, guys? We will also follow 3. Simple. Clear? Sir, should I not follow 4? There is nothing wrong. Rounding off here and there, you will have some issues. As simple as that. So don't make a big issue about this rounding off thing and all. Rounding off issue here and there will be there depending on the decimals you take. You are free to take 3 and above, not below that. 3 and above you can take. Clear with this, guys? Let's follow 3 for our classroom discussion. Are you all clear with this? Are you all clear with this? So similarly, if I give you, find out the future value for year 3 is given. Let's say future value of year 3 is given. Final one thing we will do, and we will move to the next concept. Future value at the end of year 3 is given as 133.10. The rate is given at the rate of 10%, and they have given you a period of 3 years. Calculate present value. What will you do? What will be the formula? Yes, this is nothing but 133 point. Guys, participate. I know that you all know. Still, can you just participate? Guys, yes, divided by 1 plus 0.10 to the whole power 3, or I can just say this is 133.10 into 1 divided by 1.10 to the whole power 3. This part, take the calculator, do this. 1 divided by 1.1 is equal to how much you get? How much you get? 0.751, correct? 0.751. So this is nothing but 133.10 into 0.751. How much is this? Approximately this will come to 100. Correct or not? Guys, are you all clear with this? So compounding and discounting, are you all able to understand? With this, you can move between present value and future value. How can you make the present value and future value comparable? Using time value of techniques. From present value, if you want to go to the future value, it's called as compounding. From future value, if you want to arrive at the present value, it's called as discounting. As simple as that. Now you can compare things. You can bring everything into today's value. Then it makes sense for you in taking your decisions. Correct? Correct? Now you will be able to understand. Have you seen the concept of time value of money in costing? Have you seen it in costing? No, why? Because that the decisions you take are generally for less than a year, and within when it is less than a year, time value will not change. Are you clear? Whereas in financial management, we are talking about long-term decisions to make the cash flows comparable. I use a concept called as time value of money. Are you all able to relate it now? Are you all able to relate it now, guys? Are you all able to understand? This is the basic. This is the very basic understanding that you have. And of course, you had a future value table. Similarly, you will also have a present value table. Now, in this example, you tell me what is a present value. Here you have for year 1, 0.826. Sorry, this is year 2. Year 1, it is 0.909. Year 2, 0.826. Year 3, it is 0.751. Go to this table that I have given you. In that, you go to the second table. So, the first 2 pages are continuation. Go to the second table. What have they given? Present value interest factor of 1 rupee at I percentage for n years. So here our percentage is what? What is the rate that we have taken? 10%. At the end of year 1, what is the discount factor? 0.909. Year 2, 0.826. Year 3, 0.751. Correct or not? That is exactly what we did using these formula method. Are you all clear? So if the institute in the question, if they give you the table, just pick it up and do it. Just pick it up and do it. So here what I will do is, if in the institute, if in the exam, they have given you the interest factors, what you can do is very simple. Present value is equal to future value into present value interest factor at the rate of I percentage for n years. Clear? This is nothing but 1 divided by 1 plus r the whole power n. Correct? That is why I am directly multiplying this. It has factored the denominator also. That's why I am directly multiplying it with it. Are you all clear with this? That's why if you see in your present value table, everything will be less than 1.0. See, it will be less than 1 everywhere. Whereas in future value table, everything will be more than 1. Everything will be more than 1 because you are multiplying it. Here you are dividing. Correct? When you are dividing, obviously it will be less than 1. No? Correct or not? Yes. That is the reason why present value tables. This is another way of knowing whether you are looking at the right table or not. Correct? And predominantly in our subject, we'll be using present value tables. They will give you future cash flows and they will ask you to find out what is the present value of all of that. Are you clear with this, guys? You can either go with this formula method or you can resort to this table if it is given in the question. Guys, are you all able to understand this? Are you all able to understand this? Yes, clear with this? Is everyone clear with this? Shall we proceed further? Shall we proceed further? Perfect. Now let's go to the next one. Let's go to the next one. Concept number 5. Present value of multiple unequal cash flows. Present value of multiple unequal cash flows. Multiple unequal cash flows. What is this? What is this? Take down an example and I will explain. Year end and future value. This is all is given in the question. They are saying 1, 2, 3, 4 and 5. At the end of year 1, they are saying there is a cash flow of 1000. At the end of year 2, it's 1500. Year 3, 800. Year 4, 1100. Please note this down. Year 5, 400. What are these? These are some cash flows that will be arising at the end of the respective years. Are you clear with this? Always remember, when year is given, you should always assume it as arising at the end of the year. Are you clear with this? If I assume at the beginning of year 1 means today, correct or not? Correct or not? So if this word end is not given, simply they have given year and future values. In this case, what will you assume? You will assume that these cash flows are arising at the end of the respective years. Are you clear with this? That is one underlying assumption. Now, this assumption can also be broken. How? We will see that later. In a short span from now, we will say it. But if nothing is given, what will you assume? You will assume that these cash flows are arising at the end of the year. Clear with this? Now, they have given you The rate is equal to 10%. Calculate the present value. This is the question. Calculate the present value. So what have they given in the question? They have given you the cash flows arising at the end of 5 different years. Yes, guys, correct? Or can I call this as future values? Correct? Correct? What are they asking you? What is the value of all these cash flows that you will be receiving? What is the today's value of all that? What is the today's value of tomorrow's money? That is what they are asking you. Correct? Correct, guys? Correct, guys? Now, what is it? 1000 plus 1500 plus 800 plus 1100 plus 400. Yes? 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 Can you add monkeys and donkeys? Can you add monkeys and donkeys? This is arising at the end of year 1. This is arising at the end of year 2. Are they comparable? No. What will you do? Convert this into present value. Convert this into present value. This into present value. This into present value. This into present value. Sum total of all that will give you the total present value of all the cash flows. Only then it is addable. Correct or not? Correct or not? Can I add these cash flows as such? No. You cannot touch them. Why? Because they are arising at different points of time. Correct? And when cash flows arise at different points of time, I told you 100 rupees today, option 1, option 2, 1 or 2 tomorrow, not comparable. Convert it and then add. Convert and then add, or do take whatever decision you want. Subtract, add, whatever you want, you do. But bring everything into a common comparable term, and then you do your operation, addition, deletion, whatever it is. Clear? So I can't compare these cash flows as such. I will convert everything into the present value, and then I will add it. Clear with this, guys? Now take down the solution. Take down the solution. Can I say simply present value is equal to, now 1000 rupees is there. When is it arising? At the end of year 1. So what is the present value of 1000 today? Formula. Just tell me. Can I say this is 1000 divided by 1 plus 0.10 to the power 1? Correct? Correct. Now I will add 1500 divided by, come on, tell me. 1 plus 0.10 square. Why? Are these addable now? Yes. This is also in present value. This also I have converted this 1500 into today's value. It is addable now. It is addable now. If I convert everything into present value, these terms are addable. I can't add 1000 and 1500 as such. But if I convert everything into today's value, I can add it. Correct or not? Yes. Are you all understanding this? Are you all understanding this? So, 1 second. Okay. Then come on. 800 divided by, everyone answer. Guys, everyone answer. 1 plus 0.10 to the power 3. Correct. Then plus 1100. 1100 plus 1 plus 0.10 to the power 4 plus 400 divided by 1 plus 0.10 to the power 5. Are you clear with this? This is called as a cash flow equation. This is called as a cash flow equation. Only if you convert everything in today's value, it is addable. It is addable. Clear with this? Are you all understanding this? Are you all understanding this? These cash flows are not addable as such. Do some operation and convert everything into today's value. That operation is called discounting. Correct? You arrive at today's value and then it is addable. Are you all clear with this? Are you all clear with this? Now what you need to do is, now just calculate. What I will do is, first, this is 1000 into something. Okay, something. We will use a calculator later. Okay, 1000 into something plus 1500 into something. What is this something? 1 divided by 1.1 to the power 2. Correct? So we will do the calculator as and when it comes. First, let us frame this equation and plug the figures here. This is 800 into something plus 1100 into something plus 400 into something. Now, please fill all these things. Take your calculator. Write down 1 divided by 1.1 is equal to, how much is it? Guys, 0.909. Then click one more is equal to, how much is it? 0.826. One more is equal to how much? 0.751. One more is equal to how much? 0.683. One more is equal to how much? 0.621. 6209. You just round it off. Clear? 5 and above, round it off to the next number. Clear with this, guys? Clear with this? Are you all able to understand? Are you all able to understand? So tell me the values. Tell me the values. Okay, so 909. I'm relaying your numbers. Tell me. 1, 2. 1239.6. Okay, fine. 6. 601 point. Appendix எடுக்க சொன்னேனா இல்ல பட் appendix இது தானே வரும் இதே தானே பா வருது. See, whatever you've done here, appendix, I have just told you how to use it. If it is there, it's simple. It's very simple. But let's do it in the classroom. Let's do it in the classroom. That's why I've done it. Okay, fine. So what is the second? 800 into 0.751. How much is it? 600.8. 600.8. You took 4 decimals. 601.05. Okay, fine. Then 7 1.3. Then 248.4. Okay, whatever is this, this is always an issue. Rounding up here and there. Finally, tell me what is the total value. 374. I'm getting 3748.50. Has anyone got this? 3748.7. Guys, what happened? What is the problem here? Don't round it up here. Don't round it up here. Once you get it, finally, why you can maintain 3 decimals. Let's have that habit. We can maintain 3 decimals. Let's not round off anything. Let's maintain 3748 point. You're getting 3748.75 something. More or less, it is one and the same. Always, this is a problem. Some people take 3 decimals, some people take 4 decimals. Accordingly, 1 or 2 rupees might change. Maximum, that's all. But are you getting the concept? Guys, are you all getting the concept? In exam, if the table is not given, please do it like this. This is your conceptual understanding. Clear? This is where the execution part, the tricks and all these things, this is where comes into picture. Clear? If you write this, it clearly shows your understanding of the subject. What is the understanding? The cash flows cannot be comparable as such, since it is occurring at different points of time. I am converting everything into present value and then only adding it. That is where the concept comes in. Are you all clear with this? Guys, is this understandable to everyone? Yes, we are spending a lot of time. Don't think sir, if you slow up we will finish. Don't worry about it. Don't worry about it. I told you on day 1, one more quote I told you, Abraham Lincoln's quote I told you. Yes, give me 6 hours to chop down a tree. I will spend the first 4 hours sharpening the axe. Spend more time on learning the concept. Problem solving is nothing. It will take just little time. You will see how many number of sums you can finish very, very quickly. Provided if you're very strong in your concepts, no one can shake you. No one can shake you. That is how it is. You take any example. Take big players like Virat Kohli, Sachin, anyone you take them. Every day before they come to the match, they practice. Will they say, I know, that's all? No. Every day they practice. Every time they bat, they say that they learn new things, or they say that. Of course, these people, they say that they are experts in that. Still, what I'm telling you is, if you are able to do it, and if you're consistently practicing, and if you're learning the concept, spend more time. What happens in actual, that is when you're taking, the time that you take while solving the question will be very, very less. I will prove it right in front of you. Right now, let us take this time in learning one by one. Slowly, I will increment. For the time being, have you all understood this? Have you all understood? Is this understandable? Any doubt here? Yes, clear with this? Perfect. Shall we move to the next one? So far we have covered 5 concepts. Take the 6th one. Don't worry, I will summarize everything at the end. Right now, you just focus on one concept at a time. I will revise everything, or I will show you the overall graph as to how we have proceeded. You will automatically be able to connect the dots. Right now, see, please write down present value of multiple. Take a red ink and write equal. Multiple equal. Come back to green ink. Cash flows. Multiple equal cash flows. What happened? Everything is fine? Okay. Shall we proceed? Guys, shall we proceed? Yes. Now, The same, let me take one more example. Year and this is what? Future value. Year, future value. 1, 2, 3, 4 and 5. Future values 100 throughout. 100, 100, 100, 100 and 100. Rate is given as 10%. Calculate present value. Can you do this? Guys, can you do this? Any difficulties? What is the difference between the previous example and this example? Here the cash flows were different, erratic, 1000, 1100, anything. Here I am saying I will receive the same fixed amount at the end of every year. Sir, what is the new thing that we are going to learn here? We will see. We will see. I'll let you know. Yes, are you all able to understand? Simple. First, can I add all these 5 together? 100, 100, 100 I can add. 100 at the end of year 1 is equal to 100 at the end of year 2. Definitely not. Can I add? No, here also I need to discount it. Concept is one and the same. So write down solution. Guys, write down present value is equal to, frame the equation, cash flow equation. Please tell me what is the equation. Guys, everyone participate. I told you, learn like a child. Yes, 100 divided by 1 plus 0.10 to the power 1 plus 100 divided by 1 plus 0.10. Please write down. Don't think that I know all this. Please write it. Please write it. Yes, then 100 divided by 1 plus 0.10 to the power 3 plus 100 divided by 1 plus 0.10 to the power 4. Then 100 divided by 1 plus 0.10 to the power 5. Clear? Clear, guys? Clear, guys? So in the previous sum only we just found out this is nothing but 100 into something plus again 100 into something else plus 100 into something. Like that you need to do 5 times. Correct? Plus 100 into something. So tell me what are the present value interest factor? 1 divided by 1.1 is equal to how much? 0.909. Again click is equal to how much? 0.826. Once again click is equal to how much? 0.751. Am I going fast? Sure? Yes, these are all some already basic concepts, so I'm just trying to be a little quick. Should I slow down the pace? No, sir. Can I continue? Okay, fine. Then fourth year, once again is equal to 0.683, then 0.621. Clear? Guys, clear? Clear. Now, one second. Now, one uniqueness about this question is, I have 100 common. Correct? I have 100 in common. Correct? Correct. I know for the next 5 years, every year I'm going to receive 100 rupees. Receive or pay, whatever it is. Cash flow can be inflow or outflow. 100 rupees, assume I'm going to receive. Correct? So can I take out 100 in common? If I take out 100 in common, this will be like 100 into 0.909 plus 0.826 plus 0.751 plus 0.683 plus 0.621. Correct? Simple mathematics. Simple mathematics. I have not even entered into FM. I am just still in mathematics. Simple mathematics. Take 100 common. You can write these things. Add it up. Yes or no? So add up and tell me 0.909 plus 0.826. How much? 100 into how much is it? What? It's going to be 3.791. You just add it up. You just add it up. It's going to be 3. What is 3.791? It is sum total of all the discount factors for the respective year. Sir, how can these be added? Because they are multiplied with the same amount of cash flow I'm taking in common. Correct or not? Correct. Are you all understanding this? How much is the value? How much is the present value today? Yes, how much is it? 379.10. Sorry, this is just 379. Okay, so it is 379.0. Oh, it's only 379. Okay, fine. It's only 379. Decimals, fine. Forget it. Are you clear with this? Are you clear with this? Now, guys, please listen. You want me to explain anything? Don't hesitate. If you don't know something, please ask me. You stuck somewhere? Sure? You stuck somewhere? Guys, please feel free to ask me. That is one basic thing. I am here for your purpose. And if I'm not able to fulfill that, then it's of no use. If you don't understand something, please ask me then and there. You're finding some difficulty? Tell me, what is it? Edu first time explain panna. Last add pandring. Okay, fine. This cash flow equation, are you able to understand? This cash flow equation you are able to understand. I am saying 100 rupees received at the end of multiple years are not addable as such. 100 rupees received at multiple different point of time is not addable as such. Yeah, because this is 100 rupees received at the end of year 1 and this is 100 rupees received at the end of year 2. Can I add this directly? No, I need to convert everything into present value. That's what I did using this equation. Correct? Present value equation, I just did it. Now this is nothing but 100 into 1 divided by 1.1 to the power 1, 100 into 1 divided by 1.1 to the power 2, 100 into 1 divided by 1.1 to the power 3 and so on. This 1 divided by 1.1 to the power 1, 1 divided by 1.1 to the power 2, I have just calculated using my calculator, arrived at it separately, and I have just reframed the entire equation which was in fraction. Right now I have put it as decimals, and right now I can see that 100 is a common multiple here. I took 100 outside and automatically I am just adding all other present value factors. Guys, any issue here? Any issue here? Are you able to understand? Further, if you're not able to understand, after the class you can ask me. Clear? Okay, fine. Guys, you're all able to understand this? Yes, really? Yes. Now, why am I able to add all these things? Because it is getting multiplied with the same number, correct? And this concept is called as present value interest factor of annuity. Present value interest factor of annuity. Present value interest factor of annuity. When will you use this? Now there is a separate table. There is a separate table. You saw the financial tables, right? Financial table. Two different tables we saw. One was the present value interest factor. The other one was future. First we saw future value interest factor. Then we saw present value interest factor. Now we are seeing one more thing called as present value interest factor annuity. What is this? This is nothing but sum total of my present value table. That present value table. For example, now guys, for example, let us prepare this table. Let us prepare this table. Year 1, 2, 3, 4, 5. Present value interest factor 10%. Now guys, simple. Let us just take this example. Now you tell me what is the present value interest factor. Here you got right. 0.909. That is 1 divided by 1 plus r the whole power n. So when the interest rate is 10%, what is the first year interest factor? How much is it? 0.909. What is it for second year? Not annuity, just simply for second year. How much is it? 0.826. Third year, 0.751. For fourth year, 0.683. For the fourth year, 0.621. Correct? Now, when the cash flows is equal, I can take that cash flow outside and I can accumulate only this interest factor. Correct? That is called as annuity table. So, present value interest factor of annuity for 10%, can I say for year 1 it is going to be 0.909. For year 2 it will be 0.909 plus 0.826. How much is it? Add it up. 1.735. For year 3 it is going to be how much? 0.909 plus 0.826 plus 0.751. How much? 2.486. For year 3 it's going to be, add this also. For year 4, 3.169. For year 5, 3.79 and something. Yes, are you clear? Right now we did it for 6 years. We did it for 5 years. So this is what we have got here. Did you see how we have got this? We have just added the present value interest factor for the 5 years put together. Are you clear with this? This is present in a table called as present value interest factor of annuity table. Now let me just show this to you. Open that table, financial table that I've given you. There you can see present value interest factor A7. Okay. Look at this. Present value interest factor of annuity of 1 rupee. That is, every rupee becomes how much? If you look at this, it is 0.909, 1.736. This is nothing but interest factor of year 1 plus year 2. This is nothing but interest factor of year 1 plus year 2 plus year 3. This is nothing but year 1 plus 2 plus 3 plus 4. This is nothing but 1 plus 2 plus 3 plus 4 plus 5. Are you clear with this? This is the same figure that we got here. This is the same figure that we got here. This is the same figure that we got here. This can also be referred to directly from the table. And when will you refer the annuity table? When you have equal cash flows arising in your futures. Are you clear with this? Are you clear with this? Nothing. Simple. The present value, if you just aggregate it, if you aggregate the present value table, you get your present value annuity table. Are you clear with this? And this can be used only if the cash flows are same. Only if the cash flows are equal. Are you all able to understand this? Guys, are you all able to understand this? Yes. Is everyone able to follow? Is everyone able to follow this? Clear? Shall we proceed to the next one? Shall we proceed to the next one, guys? Yes? Okay, fine. Now, so till now, what we have seen? We have seen the simple your present value, future value, how to toggle between that. The formula we have seen. Your present value is equal to future value divided by 1 plus r the whole power n. Then what will happen if there are unequal cash flows? We saw. And what will happen if there are equal cash flows? Technically, concept wise, both are one and the same. But if you have equal cash flows, you can take the cash flow in common and aggregate the discount factors separately. That aggregating the discount factor separately is called as annuity. That annuity table you can find out. Are you clear with this? Are you clear with this? Fine. Let's move to the next one. Let's move to the next one. Please write down the seventh one, the seventh concept that we are learning today. Present value of equal cash flows up to perpetuity. What do you mean by perpetuity? Forever. Correct? Forever. Yes? Guys, clear? Now, let's say, I want to invest in a company. That is, I want to buy shares of a company. Correct? When I'm buying shares of a company, now, why am I investing in this company? I know that this company is going to perform well. Correct or not? Now, companies go on what assumption? Going concern assumption. Correct or not? They will be forever. Correct? That is the assumption. At the time of starting the company itself, will they think about winding it up? Will they know that, okay, exactly for 5 years only this company will be open? Is there anything like that sort? No. So in a real life situation, you know that if I invest some money in a company, for lifetime I will be receiving some dividends. Correct? I will be receiving some dividends. Now, let's say every year I receive some money. Let's say 5 rupees every year I receive. Till how many years? I don't know. Correct? Till now we knew the number of years. 5 years, every year you could discount easily. But if it is going to be forever, can you also keep extending that equation, cash flow equation? It only keeps going. There is no tangible end to it. Correct or not? Correct or not? In this case, what do you do? So let's take an example. Let's say year and cash flows are given. Cash flows or future value. You can take anything. 1, 2. At the end of year 1, let's say the cash flow is 100. Year 2, let's say the cash flow is 100. Year 3, cash flow is 100. It goes on like that till infinity. You don't know. It doesn't have any end at all. Clear? It goes on. So basically, the scenario that I've taken is, I will be receiving 100 rupees at the end of every year. For how many years? I don't know. I will keep on receiving it. I will keep on receiving this money. That's all. I don't know. There is no tangible end to it. This is an indefinite period. Correct? In this case, I should find out the present value. How will you find out the present value? You know the present value equation. What is the equation? Guys, tell me the exact equation. You tell me. 100 divided by, and of course, let us take the rate to be 10%. Example, sir, why do you take the rate 10%? How do I arrive at the rate? That is one separate chapter by itself. We will see it later. For the time being, I will just tell you what the rate is. You just accept it. Later on, we will see how to arrive at the rate and all of that. Clear? This is called as a discount rate. Basically, this is called as a discount rate. If you are using it for discounting, it's called discount rate. If you're using it for compounding, it's called as compounding rate. Thank you. Fine. It was much needed. I'm really sweating. Okay, fine. So let's calculate the present value. Let's calculate the present value. Right. Now you tell me, ideally, how will your cash flow equation look like? 100 divided by, come on, 1 plus 0.10 to the power 1 plus 100 divided by 1 plus 0.10 to the power 2. It goes on. Is there an end to it? Is there an end to it? Can you actually keep doing it like this? There should be some tangible end, correct or not? Can this be added? Manually, can this be added? Sir, then what is the formula, sir? How will I do it? Sum total of all this, that is the present value today, correct? Please take a red ink and write down. In this case, the present value is equal to, please write down, annual cash flow divided by discount rate. Annual cash flow divided by discount rate. Very simple. The formula is very simple. So what is your annual cash flow? Every year, how much will you receive? 100 rupees, correct? Sorry, this is not 1000, this is 100. By mistake, I wrote it. Okay, so this is 100 rupees divided by discount rate. What is your discount rate? What is your discount rate? 0.10. How much is this? How much is this? 100 divided by 0.10. How much is it, guys? Use your calculator. What are you looking? Use your calculator. How much is it? 1000 rupees. So this is the answer. So the present value of 100 rupees that I will be receiving forever is 1000 rupees. Correct? Using the formula annual cash flow divided by discount rate. Now, sir, how did you arrive at this? This formula, how did it come? This formula, how did it come? Now, in exam, it's enough if you write this. But you should know why this formula has come. Correct? I will just take little more time. I will do it on a blue ink because it's not required from an exam point of view. Now, I will do it. I will tell you why they have arrived at this formula. For this, I need your cooperation. Whatever I ask, answers you need to keep telling me. Have your calculator. Just keep telling me the answers. Clear? Clear with this? Yes. First of all, what is the scenario that we have taken? I am receiving equal cash flows till perpetuity. I need to find the sum of equal cash flows that is being received till perpetuity. The present value of that we need to find out. Correct? Yes. Yes, that is the issue. And I told you the sum total of all the cash flows that you will be receiving in the future, the formula is annual cash flow divided by discount rate. The question is how, sir? Yes, that is what we are discussing right now. Is it required from an exam perspective? No. But conceptually, only if you know, only then you will be able to relate as to why we are doing this. I can tell you some 100 formulas and ask you to mug up and go. But only if you know the formula, the background, that's when you will have a control and grip over the subject. By the way, what I'm going to discuss right now has nothing to do with FM. It is your mathematics. All these things are simple mathematics. We have not even entered into FM. These are some mathematics. So I will tell you certain things that you can relate. With that, we will understand the reason for this. Shall we, guys? Shall we? Fine. First. Now, do you guys know GP? Not GP Muthu. GP. Yes. Geometric progression. Gross profit. Wow. Okay, right. GP is gross profit. Accounting perspective. Okay, great. I told you, mathematics. Okay, right. Okay, fine. Okay, so in your mathematics, I should start like this. GP you have read? Yes, sir. Yes. What does it stand for? Geometric progression. Example for GP, can I say 2, 4, 8, 16, 32, so on. First, when will I call a series as geometric progression? When there is a common ratio. You take any two adjacent numbers and divide it. Here, if I do 4 by 2, how much I get? 2. 8 by 4, how much I get? 16 by 8, how much I get? 2. Correct? Which means the common ratio between two adjacent numbers is a common number. Correct? The ratio between two adjacent numbers is a common number. Yes. only if a series indicates a common ratio, it can be called as a geometric progression. Correct? Yes, correct. Now in your geometric progression, there was a formula that you guys would have studied. Sum of infinite geometric progression is equal to A divided by 1 minus R. Correct? Correct? Where A stands for the first term, that is the first number, and R stands for what? The common ratio. What do you mean by the common ratio? In this case, the common ratio is 2. Correct? Sum of infinite geometric progression is what? A divided by 1 minus R. That is A divided by 1 minus R. Sir, how this formula came? Ask your mathematics faculty. Yes, how this? Idukku mela ponana thesis da eludano. That is not required. You guys are aware of this sum of infinite geometric progressions? Yes or no? Right now, what is the equation that we have got? This is the equation that we have got. Correct? We need to sum total of all this. For this, first we should find out whether this series is a geometric progression. Correct or not? Guys, correct or not? So now this series, what is this series? This is 100 divided by 1.10 to the power 1 plus 100 divided by 1.10 to the power 2 plus 100 divided by 1.10 to the power 3 plus so on. Correct? Guys, correct? Now, I will be able to use this formula only if this series is a geometric progression. Correct? So first I need to prove whether this series is geometric progression or not. Correct or not? What can I do? Divide this by this and see. Then divide this by this and see. Correct? Any two adjacent you take. If the answer is same, it means it is a geometric progression because it has a common ratio. Correct? Can we just do that and see? Take the second number. What happened? Take the second number. 100 divided by 1.10 square divided by 100 divided by 1.10 to the power 1. Correct? You know how this happens. This 100 divided by 1.10 square into 1.10 to the power 1 divided by 100. Correct? This gets knocked off. Correct? This gets knocked off to the extent of 1. This is nothing but 1 divided by 1.10. Correct? So what I did, the second term divided by first term I did. Correct? Now what I am going to do, the third term divided by second term. If that also indicates 1 divided by 1.1, I can say that this is a geometric progression. Are you all able to follow? This is foundation mathematics. Correct? So let's do this. The third term is going to be, participate, 100 divided by 1.10 to the power 3, the whole divided by 100 divided by 1.10 to the power 2. This is nothing but 100 divided by 1.10 to the power 3 into 1.10 to the power 2 divided by 100. This gets knocked off twice. This becomes 1. This is also 1 divided by 1.10. So now do you agree that this is a geometric progression? Yes, guys. And sum of infinite series in an infinite geometric progression is A divided by 1 minus R. Correct? A divided by 1 minus R. Where R is what? The common ratio. Shall we substitute? What is the first number? What is the first term we have? 100 divided by 1.10 to the power 1. Correct? Divided by 1 minus, what is the common ratio? Just now we found out. 1 divided by 1.1. Correct or not? Divided by 1 divided by 1.10. Correct? Now what will you do here? 100 divided by 1.10 to the power 1 is same. Minus, so you take an LCM here. This is nothing but 1.10 minus 1 divided by 1.10. Correct, guys? Yes, correct. So you just remove the 2. This is divisible. This becomes 100 divided by 1.1 minus 1. Correct? How much is that? 100 divided by 0.10. This is nothing but annual cash flow divided by discount rate. Correct or not? Guys, correct or not? Guys are getting this. This is nothing but your annual cash flow divided by your discount rate. Are you all able to follow this? Don't worry. You want me to share this with you? This whatever I have scribbled? Yes. So this I will convert it into a PDF and put it on the group. You guys can have access to it. But just because I'm doing this, please don't take running notes. My running notes might not be, as comprehensive as you take. So please have the habit of taking running notes. Keep this as an external reference. In case you feel you have missed out something, you look at this, you will understand. Clear? Clear? I will share this with you, don't worry. But anyways, I just want you to take running notes. Please don't leave the habit of taking running notes. It's a very good habit. Clear with this, guys? This is a derivation. Sir, the derivation, forget it, it's okay. Take it as annual cash flow divided by discount rate. Clear? Fine. But it is my duty to explain why things have come here. That is the reason I'm giving you. Don't accept something just because it is given. Clear with this, guys? Are you all able to understand? Is anyone having any doubts? Is anyone having any doubts? Sure. Shall we proceed forward? So tell me one last time. What is the present value of equal cash flows up to perpetuity? What is it? Annual cash flow divided by 1 minus Sarah. Divided by discount rate. Annual cash flow divided by discount rate. Logic, geometric progression, sum of infinite series. I have derived it and shown it to you. Clear with this, guys? Clear with this? Clear? Now let's move to the next one. Let's move to the next one. The next concept, concept number 8. Write down present value of perpetual growing cash flow. Perpetual growing cash flow. Present value of perpetual growing cash flow. Perpetual growing cash flow. What is this, sir? Now, I told you, I invest in a company, I will be receiving 100 rupees dividend every year. You tell me logically, the company, will they be paying 100 rupees exactly every year, or exactly as in, will they be paying the same amount forever? The company will also grow, no? As they grow, they will also pay me more, right? Correct or not? Correct or not? So when there is a growth, and that growth is up to perpetuity, let's say every year the cash flow also grows at the rate of 5%. Okay, it grows up to perpetuity. In this case, how do I add the sum? How do I add all the cash flows? That is the example. I'll give you an example. Please write down. Please write down. Write down. Mr. A. Yes. I'll just tell you that. Let's finish this and then I'll come to that. Okay. Please write down. Mr. A wants to receive rupees 100 at the end of year 1. After that, he wishes to receive a cash flow that grows by 5% every year up to perpetuity. Rate is equal to 10%. Calculate the present value. This is the question. Now, what are they saying? Basically, to put it in rough, can I say 1, 2, 3, 4, so on. The cash flow will be at the end of year 1, he wants to receive 100 rupees. At the end of year 2, how much he says he wants to receive? This has to grow by 5%, correct? So he says 100 into 1.05, correct? How much is this? 105. Third year, 5% further growth as compared to 105. So can I say the third year cash flow will be 105 into 1.05, not 110. It is not a simple interest. It is not simply 5% every year. 5% on the previous year. This 5% will calculate on the previous year. This 5% will be calculated on the previous year. Are you clear with this? How much is this? 110.25, and it grows on like this. Clear. The That is, your cash flows are showing some trend. They are showing some trend. It is moving in a particular direction. Correct or not? Or can I say this at the end of third year, this is nothing but, see, this 105, what is it? 100 into 1.05, correct? Further, this gets multiplied by another 1.05. Or can I say this is nothing but 100 into 1.05 to the power 2? Correct or not? Correct or not? Yes. For the next year, it will be what? It will be what? 100 into 1.05 to the power 3. Correct, guys? And it keeps on growing. It keeps on growing. It keeps on growing. So let me just put it here. 1, 2, 3, 4. So the cash flows will be 100 here. The cash flows will be, at the end of year 1, it will be 100. At the end of year 2, it will be 100 into 1.05 to the power 1. Here it will be 100 into 1.05 to the power 2. This will be 100 into 1.05 to the power 3, and it goes on like this till infinite. Correct or not? Yes. Why? Because they are saying, sir, are we doing any discounting here? No, no, no. They are saying the cash flow, the manner of computing the cash flow they have given in the question. They are saying the cash flow grows at the rate of 5% every year. When I say 5% growth, it means growth as compared to the immediately preceding year. This 5% should be compared to this year. This 5% should be applied on this. Are you clear with this? Keep on adding another 5%, and that's how you arrive at it. Guys, are you all clear with this? Yes, are you all clear with this? Yes. So now tell me, how will your cash flow equation look like? How will your cash flow equation look like? How will your cash flow equation look like? Present value, can I say this is 100 divided by 1.10 to the power 1. 1.10, how I got? 1 plus 0.10, correct? Second year, can I say 100 into 1.05, this is growth, correct? Divided by 1.10 to the power 2, correct? Correct, guys? Are you all able to understand? You want me to repeat anything? You guys want me to repeat anything? Yes, what do you want me to repeat? Here I'm telling you, this is the cash flow computation, correct? This cash flow, I put it here, correct? And I'm discounting, normal discounting I'm doing. So what is the discount? How will I discount it? What is the formula? Your future value divided by 1 plus r the whole power n. That remains the same. 1 plus r the whole power n. First year. Here it is second year. So 1 plus r the whole power 2. Third year, the denominator will have 1.1 the whole power 3 and so on. That is the discount factor. But cash flow, how it will grow? At the end of year 1, 100. At the end of year 2, 100 plus an additional 1.05%. At the end of year 3, it will be, on this I will apply another 5%. So can I say 100 into 1.05, that is this year's value, into once again 1.05. This is nothing but 100 into 1.05 to the power 2. That is the cash flow at the end of year 3, correct? This divided by normal discounting, 1.10 to the power 3. Guys, are you all able to understand the way in which I have framed this equation? Puriyarda, you want me to repeat anything? You are able to understand this? You guys are able to follow? Is everyone able to follow this? Is everyone able to follow? Yes, guys? Please participate. You are all able to understand, right? If I'm going fast, please stop me there and there. Please stop me there and there. You guys are able to understand. Fine. And this goes on like this till perpetuity. Clear? Yes, clear? And you all know, when this goes on to perpetuity, what is the logic that we take? Geometric progression. Geometric progression. Correct? Geometric progression. So geometric progression, what does it say? In case of infinite cash flows, sum of infinite geometric progression is going to be a divided by 1 minus r. But before that, first we should understand, we should see whether this is a geometric progression or not. This is a geometric progression or not. Okay, but before that, first write down the formula. In this case, take a red ink and write. The present value is equal to cash flow at the end of year 1, that is cash flow at the end of year 1, divided by discount rate minus growth rate. Discount rate minus growth rate. In our example, guys, just substitute and tell me, in our example, what is the cash flow at the end of year 1? Actual amount. What is the cash flow at the end of year 1? What is the cash flow at the end of year 1? Please, everyone tell me, what is the cash flow at the end of year 1? 100, correct? 100 divided by, what is the discount rate? What is the discount rate? Discount rate 0.10 minus, what is the growth rate? 0.05. I told you, it grows at 5%. 0.05. So how much is this? 100 divided by 0.05. How much is this? How much is this? This is going to be 2000 rupees. So when your cash flows increases based on some growth rate, the sum total of all that, if it is given for an infinite period, the formula is cash flow at the end of year 1 divided by discount rate minus growth rate. Are you clear with this? Now again, the logic for this is sum total of all your geometric progression. In case of a geometric progression, sum total of infinite geometric progression series. Shall we just prove it? Shall we just prove it, guys? I'm just taking a blue ink. It's not required for exam, but I'm just giving you the logic. Sir, this formula, how did you arrive? Mathematically. Simple, it's simple max. Simple max. Now you tell me, is this now this cash flow series that I've given you, is this a geometric progression or not? How will you know? Divide any two adjacent items. If it gives you the same number, it means it has a common ratio and hence it is a geometric progression. Correct, guys? Can we just try the second factor divided by the first factor? Can we just try this? What is the second factor? 100 into 1.05 divided by 1.10 square, the whole divided by 100 divided by 1.10 square. Correct? Correct? Sorry, it's not square. It's the power 1. I'm sorry, my bad. Correct? To the power 1. So this is nothing but 100 into 1.05 divided by 1.10 to the power 2 multiplied by 1.10 to the power 1 divided by 100. Simple division, it becomes ulta when you're multiplying, correct? So this gets knocked off. This gets knocked off, correct, guys? These two gets knocked off. Yes or no? Yes or no? And here it gets knocked off once, correct? So basically you will get 1.05 divided by what? 1.10, correct? 1.05 divided by 1.10. This is what you get if you divide the second number by the first number. Can you do and tell me if you divide the third number by second number, do you get the same 1.05 divided by 1.1? Guys, are you able to follow what I'm trying to say? What I did was, this second cash flow divided by first cash flow, I got one answer. What was that answer? 1.05 divided by 1.1. Now what I'm trying to do, the third cash flow divided by second cash flow, I'm doing it and I'm trying to find out whether it is giving me the same answer. If it gives me the same answer, what is it called as? The series is called as a geometric progression. If the series is geometric progression, then sum of infinite geometric progression series, I can use the formula A by 1 minus R. Yes. Can you just do 3 divided the third number divided by second number? If you do, I'm sure you will get the same 1.05 divided by 1.1, correct? So trust me, it is a geometric progression. Clear, guys? Clear, guys? Now, when it is a geometric progression and you want to sum the entire series, what is the formula you can use? A divided by 1 minus R, where A is the first term, that is the first number, and R is the common ratio. In our case, the common ratio is this, correct? 1.05 divided by 1.10. See, all these things are not required from an examination perspective, but I'm just giving you the logic behind these formulas. So tell me, what is the first term? The first number, what is it? So this is going to be 100. What started? 1 second. Okay, fine. Now, what is the first number, guys? What is the first number? No, first number of this particular series. 100 divided by 1.1, no? Correct? So 100 divided by 1.10 to the power 1 divided by 1 minus R. What is R here? 1.05 divided by 1.10. Can anyone just solve this? 100 divided by 1.1 divided by 1.10 minus 1.05 divided by 1.10. All this is mathematics. You can just cancel these two. This gets 100 divided by how much? 0.05. This is nothing but cash flow at the end of year 1 divided by your discount rate minus growth rate. Are you clear with this? 0.05 is your 0.10 minus 0.05. Are you clear with this? Basically, we are using geometric progression. That formula, we are just substituting it here and we have arrived at it. Clear with this, guys? So equal cash flows, sum of equal cash flows received to infinity. What is the formula? Cash flow, because every year it is going to be the same. Cash flow divided by the discount rate. Clear? If it is going to be on a growing model, what will you do? The first year cash flow divided by discount rate minus growth rate. The logic for the two formulas are nothing but sum of infinite geometric progression series. Are you clear with this? Is everyone clear with this? Is everyone clear with this? If they give you to infinity, can you do it? So if they are giving some series of cash flow to infinity, there can only be two models. One is same amount received every year to infinity, or number two, here is some incremental growth every year till infinity. There cannot be unequal cash flows. There cannot be unequal cash flows. Why? If they are giving unequal cash flows, they should tell in which year you receive what. Correct? If they are able to tell which year you are receiving what, it becomes a finite cash flow. No, it is not infinite. Correct? So if it is infinite, it can either be equal to infinity or it can be growing to infinity. You cannot have some unequal till infinity and all. Are you clear with this? Are you all clear with this? So equal amount to infinity, sum total of that is simple cash flow divided by discount rate. Now if it is on a growing model, cash flow at the end of year 1 divided by discount rate minus growth rate. Logic, geometric progression. Clear with this? Are you all clear with this? As simple as that. Fine, guys, clear with this. Now let's quickly move to the next one. Let's quickly move to the next one. Yes. Correct. Cash flow. Okay. You are saying cash flow plus divided by discount rate plus the growth rate. I need to work out, maybe after the class I will be able to solve that. Okay, but for that, till now whatever concept has been done, is anyone having any kind of doubts here? Are you guys clear with this? Are you guys clear with this? Yes. Let's move to the next one. I think we've covered 8 concepts. So yes, so let's go to the 9th concept. 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 Write down annuity. Don't worry, guys, this and one more, and then today's class I will close. Don't worry, little early itself I will close. Happy? Yes. I know I don't want to overburden you with too much of figures as well. So obviously my intention is not to thrust you with everything. At the end of the day, even little whatever you were learning, that also will go off. So we will learn a bit whatever is it, but please revise and come. I know right now I have told so many areas, you're like, okay, he said something. Unless and until you go home and revise, is not going to come. And we will be referring to this throughout our subject. So please go through it. I know you might be having a few other doubts. Please ask me whenever you get it. Then and there, when you get it, you can just ask me anytime. Clear? But ensure that you're strong with the concepts. The logic, framing the equations and all. You should know what to do, when to do, how to do. Clear with this? Now let's take another concept called as, you have any doubt? Okay. Let's take another concept called as annuity. Let's take a concept called as annuity. I'll tell you what this is. This is not that annuity I told you, no. Summation of all your interest factor. This is not the same annuity. Why that is called annuity and all, I will just tell you. Okay. Just branch it into two. This is also your foundation syllabus. You have heard this deferred annuity due. Yes or no, whatever you say, anyways, I'm going to do. Don't worry. Okay. So please write down deferred annuity. Deferred annuity and annuity due. Deferred annuity and annuity due. What do you mean by deferred annuity? When the cash flows arise at the end of each year. Annuity due means when the cash flows arise at the beginning of each year. Now cash flows can arise at any time. Yes, certain cash flows can arise at the end of the year, or certain cash flows can arise at the beginning of the year. Now I know you might have one doubt, sir, what happens if it occurs during the year? Yes, obviously in real life during the year, let's say on 25th July, I received so much amount of cash flow. So discount factor should exactly consider that date and all, no? So I should discount for a proportionate year and all. See, if you see at the end of the year I receive, I know, okay, fine. When I'm discounting for 1 year, I will do. Let's say I'm receiving after 1.5 years. Then I should use the discount factor pertaining to 1.5 years, correct? Till now, what we have seen, first year, then at the end of second year, then at the end of third year, and so on. So basically, we have taken only at the end of the years, correct? What will happen if it is in between a year? In real life, that scenario will arise. But in exam, they cannot ask you, because for that you need some tools, some mathematical tools. You need some Excel spreadsheets, or you need some specific tools that calculates. In real life, cash flow can generate at any point of time, no? Let's say today your customer comes. What is today's day? 27th December. Today he comes with a check of 1 lakh rupees. He says, sir, wait till the year end, sir. Only then I will do, because only then I can calculate the discount rate. Will you do that? Today he is giving even a. So you will take it today only, no? So basically in real life, cash flows can happen at any point during the year. Any day, specific day it can happen. But for the educational purpose, we will either take it at the beginning of the year or at the end of the year. Are you clear with this? How does this affect, sir? When you are calculating the discount rate, no? Yes. So 1 plus r the whole power n is there, no? 1 plus r the whole power n. Future value divided by 1 plus r the whole power n. If you see n, till now we would have seen only n can be 1 year, 2 year, 3 year. If you have received it in the mid of the year, let's say after 1.5 years you are receiving, the n will be 1.5, no? Correct? 1.5 years, suppose in between, let's say 15th of March, then proportionately that n will also change, no? 2.5 months divided by 12 months, fine. For exam, for all the limited educational purpose, all those things are not there. Either at the beginning or at the end of the year only cash flow gets generated. That is the assumption with which we are going. In real life, it's easy. It's easy for you to do if you have all these tools. If you have these tools, one click of a button, you can do it. Best tool is Excel. You can easily do anything you want in Excel. If you're good at Excel, this finance, all the finance career opportunities I told you, know, one basic requirement is Excel knowledge. From basic to advanced, you should be knowing in Excel. So they call, right now they're calling it as financial modeling. Financial modeling means bringing up with models in Excel. In Excel, coming up with your own templates. That is called as financial modeling. That's the order of the day. So coming back to our discussion, we will assume for all the purposes in our classroom, that is also applicable for your syllabus. That is only applicable for your syllabus. So cash flows can arise only at the beginning or at the end of the year. Clear with this? Clear with this? Clear with this? Now, deferred annuity can also be called as arrears. You just note this down. If you find the word 100 rupees received in arrears, okay, when I wrote my intermediate, this came in. This came in. Thank God, day before the exam, I just went through something. Exam I saw, but somehow that also came. Arrears, if they use the word received in arrears, means what? Received at the end. Arrears, you're postponing it. So you're postponing something to the end. So received in arrears. This can be also called as received in advance. Received in advance. In case in an extreme scenario where they use these jargons, you should be able to handle it. Are you clear with this? Now, one example is salary payments. Salary payment, when will they pay? You work for this month. Yes, at the end of the period, I will pay. Correct? So can I say one example for this is salary? Salary is one example. Now, where advance concept comes in, or where they will ask you to pay upfront. Sorry? Loan repayment. Typical example, this lease rents are there. No? Lease rents, yes, rent. What will they ask you? First you pay. For this month you occupy. Then before the next month starts, you pay in the beginning and then you occupy. Correct? Correct? Some people can also allow otherwise. If you see in lease payments and all, they would have made it in an agreement. Clearly, you pay and use. That's all. You pay and then you can use. Clear with this, guys? Clear with this? Some software subscription and all. OTT platforms. 12 months, 1 year subscription. Yes, you guys have this Amazon Prime, all this OTT, Netflix and all that. Yes. Now for 1 year subscription, can you say I will use for 1 year and then pay? Obviously not. Fine, you pay today and then you can use for the next 1 year. This is where the concept of annuity due comes in. Clear with this? This is also very logical. Clear? Now let us just take an example. Please write down concept number 10. Present value of multiple equal cash flows within bracket annuity due. Till now we saw what? Deferred annuity only, no? Guys, till now we saw deferred annuity. What is that? All the cash flows occur at the end of the year. Correct or not? Now in this case, in this concept, we are going to see what will happen if the cash flow arrives the beginning of the year. Are you all clear with this? Shall we proceed, guys? We will finish this and we will wind up for the day. Happy? Biggest motivation of life? Yes? Great. So let us continue. Please, at least then you stay motivated. Let us continue. Yes. So example. Take an example. Here, case 1, deferred annuity, and case 2, annuity due. Now, what happens is they are saying cash flows will be, every year cash flow will be rupees 100. Okay, guys, just listen. Every year cash flow will be rupees 100. Correct? Now let me see if you guys have understood this conceptually. They are saying every year the cash flow generated for the next 5 years, every year the cash flow generated will be what? 100 every year. Clear? If I am following deferred annuity means what? At the year end. So when will I receive these figures? Let's say year 0, 1, 2, 3, 4 and 5. Can you fill this? Year 0, what will it be? Nothing, not principal. Forget that loan concept. Please forget that loan concept. I am just telling you, you got someone is saying, I will pay you 100 rupees. Okay, someone is saying, I will pay you 100 rupees every year. Case number 1, for the next 5 years, I will pay 100 rupees based on deferred annuity model. Correct? Today is year 0. Correct? There is nothing called year 0 as such, but today I should put it right. That is already in present value. Year 0 is already in present value. Correct or not? Today do I receive anything? No, because he is following a deferred annuity concept. At the end of year 1, 100. Similarly, 100 and 100. Correct, guys? This is how your cash flows will look like. Again, these can't be added pertaining to different periods. You need to discount everything, arrive at the present value and only add. But I'm just framing how it will look like. Correct? Now, another guy says, I will pay you 100 rupees every year based on annuity due. Which means at the beginning of every year, I will pay you what? 100 rupees. Tell me, how does this stream of cash flows look like? For the first year, today itself I will receive 100. Correct? So this 100 is pertaining to the first year's cash flow. Correct? Then second year's cash flow will be received at the beginning of... Second year's cash flow will be received at the beginning of second year. Correct? Or can I say beginning of second year is same as end of first year. Correct? 1st January, 31st December. Both are literally one and the same. Don't tell me 1 day difference. Yes, literally that meager thing can be ignored. Correct or not? Can I say beginning of the next year is same as the end of the current year. So can I say year 100 rupees in year 0, 101, 102, 100 in year 3 and 100 in year 4. Year 5 I will receive nothing. So actually in year 5 beginning you would have received, that got accounted here as end of year 4. Sir, for year 4 you would have received something that got accounted as end of year 3. Clear? And so on. And the first year whatever you received, that got accounted as if it was received today. Are you all clear with this? Now this kind of scenario we have already seen in length and breadth. Clear? Now if this comes in, what to do? It's very simple, right? It's very logical. Can you guys frame the cash flow equation here? First, let me put this case 1. Let me put this case 1. Please write down, guys. Please write down. Deferred annuity. Already covered, right? Which concept? Concept number? No, deferred annuity in case of this is equal cash flows, definite here. Concept 6, please refer concept 6. Concept 6 already done. Every year, at the end of every year, I will be receiving 100. I told you, you can cumulate, take 100 in common, cumulate the interest factor that is called as present value interest factor of annuity and all. I told you. Yes, I showed you the table also. Clear with this, clear with this. Fine. So this is present value is nothing but 100 into present value interest factor annuity of 10% for 5 years. Now go to the table. Tell me how much is this, or you can also do it to calculate. You can calculate it manually. Tell me, go to the table. Present value interest factor of annuity 10% for 5 years. How much is it? Guys, if you look at this, which table is it? Present value interest factor of annuity 10% for 5 years. How much is it? 3.791. Correct or not? This cash flow equation directly, if they give this, I can multiply and arrive at the present value. Correct, guys? It's that simple. It's that simple. Yes. Tell me, how much is this? 3.791. So this is going to be how much? Rupees 379.10. Some students said they didn't get this 0.10. Forget it. Right? Are you all able to understand this? This is already done. This is already done. Are you all able to understand this? Now, our focus is on case 2. This is logical, right? This is also logical. This can be done. Yes. So write down annuity due. Please write down annuity due. With this, we'll be winding up today's session. So please focus. Let's close it up. Let's close it properly. Now, tell me, how will your cash flow equation look like? How will your cash flow equation look like? I'm talking about this scenario. I'm talking about this scenario. I'm talking about this scenario. Can I say this is 100 divided by 1.10 to the power 0, correct? Because it is in year 0. And anything to the power 0 is 1. So can I say this is 100 into 1? Why is it 1? Because it's already in present value. Correct, guys? Are you all able to understand? Are you all able to understand? You just apply the formula. It will say 1 divided by 1 plus r to the power n. What is n? 0. Anything to the power 0 is 1. So 100 into 1. Sir, why is it 1? Because it's already in present value. Year 0 only, no. Are you all able to understand this? Then 100 divided by 1.1 to the power 1. 100 divided by 1.1 to the power 2, 100 divided by 1.1 to the power 3, 100 divided by 1.1 to the power 4. Shall we just frame the equation? Shall we just frame the equation? So write down, please write down. This is where the conceptual understanding of the subject comes in. Please always write this cash flow equation. It helps you logically approach the subject. Ennachu Pushpara? Purushothaman? Yes? You have any doubt? Sure? Guys, are you all clear with what's happening here? Yes? Okay, fine. So now this is going to be 1 plus 0.10 to the power 0 plus 100 divided by, guys, answer please. Tell and write. 1 plus 0.10 to the power 1 plus 100 divided by 1 plus 0.10 to the power 2 plus 100 divided by 1 plus 0.10 to the power 3 plus 100 divided by 1 plus 0.10 to the power 4. Are you all clear with this? Are you all clear with this? This is actually the year 1 cash flow. But since it was received today itself, I am marking it as 0. This is year 2's cash flow. Since it was received at the beginning of year 2, I took it as if it was received at the end of year 1. Are you clear? And so on. Are you able to understand this? Are you able to understand this? So, can you tell me, you can look at that present value table. Now, you don't look at this don't look at the annuity table. You can just look at the present value table, or you can do the calculation. Fine. Can you tell me this is 100? I can take this out in common. 1 divided by 1.1 to the power 0 is only 1, right? Okay, fine. Let me do this. 100 into 1 divided by 1.1 to the power 0 plus 100 into 1.1 1 divided by 1.1 to the power 1 plus 100 into 1 divided by 1.10 to the power 2 plus 100 into 1 divided by 1.10 to the power 3 plus 100 into 1 divided by 1.10 to the power 4. Correct? Correct? This is what it is. And all these things, can you just take 100 common? Just take 100 common. So 1 divided by 1.1 to the power 0 is how much? 1. Plus 1 divided by 1.1 to the power 1. Use a calculator trick. How much is it? 0.909. So 1 divided by 1.1 is equal to how much? 0.909. Then click one more equal to, how much does it come? 0.826. One more equal to 0.751. One more equal to 0.683. Correct? Or can I say this is simply, or you could have directly taken it up from the table, 100 into 1 plus 3.169. Correct? Correct. This 3.169 is nothing but present value interest factor of annuity at the rate of 10% for 4 years. Correct? I could have taken it common, that I could have taken it from that table itself. Are you able to understand? Guys, are you all able to understand? So tell me, how much is this? 100 into 4.169. How much is this, guys? 416.90. Are you all clear with this? Are you all clear with this? Or in other words, can I say, when I have this annuity due concept, can I say present value is equal to, in case of equal cash flows, can I say the cash flow into 1 plus present value interest factor of annuity of whatever is it, R percentage for n minus 1 year. Correct or not? Because this we took it only for 4 years. No, you guys saw this. 1, 2, 3, 4. Only for 4 years we took. Correct? Why? Because the first year's cash flow was received today itself. Correct? And so on it happened. It is as good as I received in year 0, 1, 2, 3 and 4. Correct, guys? Correct, guys? So they would have told that I have received in 5 years, but I received it in annuity due advance. So 5 minus 1 only with respect to 4 years annuity table. We need to look at this. Can we just go check this on the table? Yes, can we just go check this on the table? So go to the table here. Where's the annuity table? 10% for 4 years, right? 10% for 4 years. How much is it? Yes, this is 3.170. In our calculation, it came to 3.169. Yes, 169, 170 are more or less one and the same. Clear? So this is what it is. So can I simply say, if there is an annuity due, you can also use this formula and say cash flow into 1 plus present value interest factor of annuity of whatever is the interest rate for n minus 1 year. Or if you want to do it logically, this way also you can do it. It is absolutely acceptable. Are you all clear with this? Guys, is everyone able to follow this? Is everyone able to follow this? Sure. Is everyone able to understand this? Clear with this, guys? Now I will just sum up whatever we have seen till now. Now, first we saw the introduction where I told you 100 rupees today, 102 rupees tomorrow at the end of 1 year are not comparable as such. Correct? Then how will you compare? Using what? Time value of money techniques. Convert today's value into tomorrow's money. Convert today's money into tomorrow's value using compounding or future value. Or if they've given the future value, find the present value using your discounting. That is your present value techniques. Clear with this? This is what we saw. Then we saw what happens in case of single cash flow. That's what we use the formula, right? Present value is equal to future value divided by 1 plus R. When there is a single cash flow, we just did it directly using the formula. We did single cash flow. Then we went on to a series of cash flow, which I call as multiple cash flow. Multiple cash flow. In multiple cash flow, broadly, we saw there could be definite period. There could be definite period or there could be indefinite period. Indefinite period is also called as perpetuity. Correct? Correct. This is also called as perpetuity. Now, indefinite period, in case of a definite period, the cash flows can be either unequal or equal. Correct? If they are unequal, what will you do? Respective year's cash flow, you use the discount rate using the present value interest factor table. Correct? If the cash flows are equal, what will you do? Take the cash flow common, cumulate all the discount factors, that is called as present value interest factor annuity table. Are you clear with this? Yes, this is what we saw. Now, in case when they have not given a definite period, they are saying it goes on till infinity, only two possible scenarios can arise. What are the two possible scenarios? Equal cash flow till perpetuity, or there could be a growth in the cash flow. There cannot be unequal cash flows and all in this case, because if there is unequal cash flows, they should tell you in which year they receive how much. If they are able to tell that, that is not called as indefinite only. Correct or not? Correct or not? In case of equal cash flows, what is the formula? Cash flow divided by discount rate, logic, geometric progression, A by 1 minus R. Clear? Clear? Now, in case of a growth, what is the formula? Cash flow at the end of first year divided by discount rate minus growth rate. Logic, the same geometric progression, sum of infinite geometric progression series. Are you clear with this? And then we went on to see a concept of annuity. Annuity, where annuity can be of two types: deferred annuity and annuity due. And deferred annuity is already seen. Annuity due we just saw right now, where the first cash flow happens at year 0. So the beginning, it means cash flow occurs at the beginning of every year. What I will do is, cash flow occurring at the beginning of year 2 will be taken as if the cash flow happened at the end of year 1 and so on. And with this normal logic, you can just do the entire question. Are you all clear with this concept? Are you all clear with this concept that has gone behind the entire discussion? Clear with this, guys? Clear with this? I humbly request you all to revise this. And in case some of your friends have missed the first lecture, without this lecture, second lecture directly they cannot enter. They cannot enter it directly. Unless and until you know this, you cannot enter into the subject. So these are some basics. Right now we have taken a long time on full class we have taken just so that we can just understand these concepts. In the future classes, I will just be giving references. If there is a series of cash flows and all, I will not be again going back to the time value of money. Ideally, we have not even entered into FM. We are just covering the basic concepts involved in FM. This is ideally a part of your foundation syllabus. Still, I just wanted to set the ground so that we can easily build upon the subject. Are you clear with this? You will see in the next class, that entire whatever sums that I've given you, all the sums will finish in a very short span of time, provided you revise everything and come to the next class. Clear with this, guys? Please revise thoroughly. If you have doubts, keep asking me. I don't mind. Please keep asking me. And of course, you guys have my number, right? On the WhatsApp group, you guys have my number. Yes, you can just keep asking me any doubts you have. You can just ask me on the group, whatever it is you want. Please get it sorted then and there. Only if you are clear with these fundamentals will you be able to move ahead in the subject. Clear with this, guys? So thank you all so much. Have a great day. Thank you.